Hi everybody, welcome back. My name is Sanjay and in this video we're going to talk about hedged and unhedged ETFs, and we're going to use Vanguard's two products, VGS and VGAD, as an example for this comparison. Now I'm going to do this video in sort of three stages. The first stage is going to be an overall snapshot. This is the comparison between the two if you just wanted a quick brief understanding of hedged, unhedged ETFs and VGS versus VGAD. The second stage will be where I go into a little bit more depth around what does it actually mean to have hedged versus unhedged ETFs. And then in the third stage, I'm going to pull out a few graphs that may scare a few people, but it's going to give you a bit more understanding as to how the performance of these hedged and unhedged ETFs vary as the performance of the currency varies, or as the currency varies in general. Now, I've actually done quite a few videos on ETFs so far. So if you think of ETFs as a broad topic, there's ETFs if you want to invest domestically in your own country, like in Australia. Then there's ETFs for if you want to invest overseas. And then there's ETFs for if you want to invest in things other than shares, like say fixed income assets like bonds, corporate bonds, government bonds. There's a whole topic on that as well. So I've done videos across these three areas. This particular topic around hedged and unhedged ETFs fits as like a subtopic underneath international shares or international ETFs. So that's where this kind of fits into the whole scheme of things. If you want to see my other videos, obviously check out the description below for links to all other videos, any other links that you might find useful. So with that being said, let's get into it. So let's start with a quick comparison between VGS and VGAD, which are the two products that we're interested in from Vanguard's product lineup. One is the unhedged version, which is VGS, and the other one is the hedged version, which is VGAD. Now straight away, let's use fees as a quick comparison point. Fees, VGS is a bit cheaper at 0.18% against VGAD, which is 0.21%. Now just as a point of reference though, what this means is for every $1,000 you're investing in, you're paying about $1.80 in fees per year versus $2.10 in fees per year. So this is the big thing about ETFs, where they're a lot cheaper compared to a lot of other forms of investments when it comes on to the share market, especially against something like a managed fund. Assets under management, AUM, straight call out where VGS is much bigger than VGAD, 2 billion against 1 billion. And what this basically means is more people have invested in the unhedged version, VGS, versus the hedged version, VGAD. Distribution frequency, this is basically how often will they pay out the equivalent of dividends for ETFs. VGS, 4 times a year, VGAD twice a year. Now the other differences are also the index and the return factors, which is just a term I've kind of thrown up, but I'll talk about that a bit later. But at this point, I'll also call out the companies that they all track are exactly the same. And you can see this by using Vanguard's own comparison tool, which I'll just throw up here, where you can see the companies that they both track with VGS on the left, VGAD on the right, are exactly the same. They have the same level of weightings across both ETFs. And also when you look at it from a country point of view, in terms of what countries are they actually invested in, it's pretty much the same in terms of the overall exposure to different companies. US 67.6%, US 67.6%. It's always the same. And that's the key thing, is each of these products are trying to invest in exactly the same companies underlying in the index. The only difference is in how they manage how the Australian dollar fluctuates against other currencies and how that impacts the returns from the fund. So bringing it back to the table of comparison, you can see that little thing at the bottom, which was around how does the return factors, or what actually impacts the returns. With VGS, you're looking at both the variation in the underlying companies in the index, plus the movements of the currency. How does the Australian dollar go up and down against, say, the US dollar and some of the European currencies? Whereas with VGAD, what Vanguard has done is basically cancelled out the impact of that. The underlying index, or the underlying performance of VGAD, is only impacted by the companies within the actual index rather than the movements of the currency. Now, I've intentionally left out the actual performance figures, the return figures, because I want to do that down the track. Because I don't want people to kind of pick up on this and say, okay, I've seen the numbers, one's better than the other, and that's how it's been over the last 5 years, therefore I'm just going to invest in this one. Because you're going to miss some of the key nuances that you really should be aware of when it comes to investing in VGS or VGAD. So let's go a little bit deeper. And this is where you can go into a bit of the documentation that you technically should be reading, the PDS, when it comes to Vanguard's VGS or VGAD products. They're actually the same PDS, but they've just separated out the segments. And let me just call out something that's in VGS in one of the descriptions for it, where they basically say, the fund will be fully exposed to the fluctuating values of foreign currencies, as there will not be any hedging of foreign currencies to the Australian dollar. Investments in the ETF are subject to the currency risk of international securities, and the value of investment may decrease because of unfavorable changes in the currency exchange rates. And then when you look at VGAD in the same document, what they call out for that is the MSCI hedged index hedge each foreign currency in the parent index back to a home currency by notionally selling each foreign currency forward at the 1 month forward rate at the end of each month. Bear with me. To construct investable and replicable indexes, MSCI calculates the performance of hedged indexes using foreign currency weights, corresponding foreign currency notional amounts, as of 2 business days before the first calendar day of the following month. Now, I don't know what all that means. I'll be honest, I'm not going to lie to you. I don't know what all that means. But what it's essentially saying is they're using forward contracts to try and manage currency fluctuations every month, and they're doing it on a monthly basis. The specific details of that you should know, I guess, but it's there in the documentation and you can read it. But that's the key call out. They're trying to manage against the currency risk. And that process of doing it is, I guess it adds to the expense, and that's why it's 0.21% fee versus whereas VGS is only a 0.18% fee. Now, if you want to go into even more detail on this, they actually have further in documentations where there's a whole risks section under the PDS where they describe how all the different risks intertwine. And there's one around currency risk and distribution risk. And I'll just throw it up here, but you can have a look at it in your own time in the PDS, and I'll obviously link that too as well. So to now do a proper side-by-side comparison, let me pull up the trends using Yahoo Finance. Okay, so we're just going to have a look at this using a couple of graphs. Now, what I'm about to do, you can do as well. It's all completely free using the Yahoo Finance website. I've gone to Yahoo Finance, I've typed in VGS, and then I've typed in comparison, and I've also added in VGAD. So this is the performance of VGS against VGAD since inception. So they all both started late 2014. And if we had held them and we had invested in both of them, say $10,000 in each, what would it have looked like along the way? VGS is blue, VGAD is red. And you can see on the right, if you had held them since the start up to now, you'd be up 55% on VGS, whereas with VGAD, you'd only be up 49% only. That's like 6% less. A couple of things to call out. Number one, this is not total shareholder return, as far as I know. I don't think this takes into account distributions. This is purely movements of capital growth over time. This is purely how did the share price go up and down, and how did that $10,000 translate, ignoring the dividends or the distributions you get, also ignoring the impact of the fees. And you can see over that time, VGS was better, but at different times, VGAD was actually a little bit ahead over time. And I can tell you right now, I believe most of this variation occurred because over this period, the US dollar got stronger against the Australian dollar, and probably the Australian dollar got generally weaker against quite a few currencies in this time. So the unhedged version actually came out better because it kind of got a bit of a boost from the Australian dollar being weaker. Now let's zoom in using year to date into the start of this year, especially looking at it around the COVID pandemic and how did that impact things. So again, on the far left, we have basically the 2nd of January as a starting point. And this is assuming we basically invested the same amount of money. They started from the same point. Where would we end up? So it's saying right now, from the start of the year to now, you would actually have been better off being with VGAD, the hedged version, because it's only lost 0.33%, versus VGS, which had actually lost negative 0.3%. That's quite interesting because when you look at the graph, you can see at various points during the year, VGS was actually better off. And this is interesting, and this is where we'll kind of call out that at in March, VGS was actually only down 17%, whereas VGAD was down around 30% or even more than 30%. But you can see over time, then that gap got smaller, and VGAD went a little bit above and has kind of held that position above. So this is all very interesting, and you're like, Sanjay, what's actually going on here? Now, this is where I'll bring in currency fluctuation. So the good thing about Yahoo Finance is you can add in another currency, or you can add in a currency. I'm going to put in AUD, and you can see AUD US dollar. And let me color it in green, so to speak. So now what we have here is the green line, which shows how did the Australian dollar fluctuate against the US dollar, the blue line, which is VGS, and the red line, which is VGAD. And if you look down on the far right, you can see the Australian dollar has actually gone up about 4% against the US dollar since the start of the year. So you can also see at various points in the year, the green line was down, and it was down about, 14%. At one point, the Australian dollar was down 14% against the US dollar. And this is where I want to call out, it looks like the blue line didn't go down as far, or VGS didn't go down as far as VGAD, because generally when international markets go down, the US dollar goes up because it's considered a safer currency. And because the demand for the US dollar went up against the Australian dollar, it's ended up sort of protecting the downside event of VGS, if I can put it like that. And this is what I'm trying to call out, that the downside events of international events have been sort of protected by the fact that the Australian dollar also got weaker against the US dollar. And a lot of the returns from VGS, remember, are from the US, and that's now translated to it kind of protecting the downside of it a little bit. So you can also see in the period since the big downward drops, the gap between the blue line and the red line got closer over time. And you can see as the Australian dollar got stronger against the US, the green lines now start to head back up. The gap between the blue and the red line started to get smaller and smaller, up to the point where the red line actually went above the blue line, in saying that having a hedged version was actually better off than having an unhedged version. And that's because the Australian dollar got stronger, and therefore the returns coming out of the US were kind of priced in as being lower, and therefore the unhedged version went down in value. That's kind of my take on it. It's probably not entirely correct, but I don't think it's entirely wrong either. Okay? So there you go, guys. I know that maybe didn't give you a lot of insight into what you should do, but I'm intentionally avoiding that topic. I just wanted to kind of describe what the difference is and let you guys make a decision on that, around what you should do. But I guess, you have to consider things like fees. You have to consider things like, do you have a view on which way the currency is going to move? And do you have a view on which way the currency is going to move over the large duration of time that you might be investing in, or over a short duration of time that you might be investing in? And you should also consider checking out Ben Felix's video, which I'll link here, which gives you a bit more insight into this stuff around hedged versus unhedged ETFs. So that's it for today, guys. If you have any questions, leave them below in the comments section, or if you enjoyed the video, obviously love to see the like button being smashed. And if you want to subscribe for more videos like this, next week I'm actually going to do a video where I'm going to look into the difference if you had invested $10,000 with, say, a savings account with Commonwealth Bank versus investing $10,000 as a shareholder with Commonwealth Bank. And I think this will be an interesting thing to look at when it comes to, especially when you're in Australia and when you're dealing with Australian banks. People will often say, gee, it's really annoying that banks always seem to take care of their shareholders more than their customers. And I think that will be interesting. I want to do that next week. So please just subscribe to see that kind of video. And with that being said, I'll see you in the next video. Bye for now.